Hey, everybody, we are now well into earnings season. We're going to be talking about one of my favorite companies to follow. It hasn't been my favorite company to own. It's still down about 50% from where I bought it, but that's neither here nor there. And I'm talking about Lemonade, ticker symbol LMND. They're the insurance technology company. Before we dive into their latest results and why the stock really rallied after them, please take a minute and check out the link you see on your screen, fool.com/Frankel. It's the best way to support this work I'm doing for YouTube. You can get the top 10 stocks to buy right now from the Motley Fool. It's a great way to support what I'm doing. Again, the link is fool.com/Frankel. So let's go through this, the latest results from Lemonade. I'm going to share my screen really quick. So you can see here, growth is still pretty impressive. Lemonade pumped the brakes on growth, prudently after after the slowdown in the zero interest rate environment disappeared. The market hit a bear market. The growth environment just got tough. The free money environment was pretty much over. So they decided to pump the brakes on growth about 2 years ago. And they recently, or not recently, about a year after that, decided to start investing in growth again. And you can really see that reflected in the numbers. Not only was in-force premium growth impressive at 24% year over year, it actually represents a bit of an acceleration over the previous year over year totals. The average customer is spending 6% more year over year with Lemonade, $384 a year. Remember, Lemonade concentrates on lower cost forms of insurance. They have, renter's insurance is their big one, but they also are increasingly shifting toward higher cost insurances like homeowners, like auto insurance and things like that. So you're seeing that starting to be reflected here. A little over 2.3 million customers. Their customer count's very impressive. They reached 1 million in a fraction of the time that most of the big insurers did. So it's clear that people are very satisfied with the product. The biggest question has been, in my mind, can Lemonade underwrite well enough to consistently earn a profit? And the latest numbers are showing yes. And this right here is, in my opinion, why the market reacted so favorably. Lemonade got their gross loss ratio down 10% year over year to 73%. Now, Lemonade has said before that its target is under 75%. It's still not there on a trailing 12-month basis, but this is pretty impressive, especially since the third quarter is historically not their strongest seasonally. The fourth quarter will be their seasonally strongest usually, so we'll see what the future holds there. But you can see kind of the peaks and valleys, and this is some seasonality reflected in the chart. But the dots are comparing the same quarter year over year, so very impressive progress. At 73%, Lemonade could be a sustainable insurance company, period. So if we look down here, you can see some of the key numbers here. Net cash flow positive for the quarter. Now, Lemonade expects to be cash flow positive pretty much every quarter going forward, except for the fourth quarter of this year. So they expect their cash balance to continue going up. I'll talk about that a little bit more in a minute. So revenue grew 19% year over year on that 24% in-force premium growth. The loss ratio, so I mentioned trailing 12 month is not quite where it needs to be yet, but definitely moving in the right direction. I'll show you a better chart of that in just a minute. So this is the fifth, as it says right here, the fifth consecutive quarter of sequential improvement in the gross loss ratio on a trailing 12-month basis. So profitability is all moving in the right direction. They're not GAAP profitable on the bottom line just yet, but they're definitely heading in the right direction. Their stock-based compensation is still a little bit too high, and I'd like to see them get that under control in the not-too-distant future. But for now, everything looks pretty strong. Here's that trailing 12-month gross loss ratio over time. I'll zoom in on that so you can see it a little bit better. You can see it's steadily been declining over the past, 5 quarters, 91%, 88, 85, 83, 79, and now 77. So if they can get that under 75 and keep it there, that is a very, very positive sign for sustainability, because Lemonade has a lot of cash on its balance sheet, as I'll talk about in a second, but it doesn't want to use it all. Efficiency has improved dramatically. This is the in-force premium per employee in thousands. So it's up from 340,000 to 731,000 over the past 3 years or so. Efficiency is clearly trending in the right direction. looking forward, they kind of reiterated what they're expecting. Adjusted EBITDA profitability next year, positive net cash flow after this year, for the foreseeable future. Their investor day is coming up, so we should get a little bit more details about everything then. But here's what I was talking about with the cash. So insurance companies need a lot of cash. Now, this isn't all necessarily spendable cash. Generally, insurance companies make money in two ways. They make it from underwriting, which I mentioned Lemonade needs to be below 75% on an ongoing basis for an underwriting profit. And from investments, Lemonade will invest its cash that it keeps in reserves. It has almost $1 billion of cash on the balance sheet. 241 million of that is required to be carried. But as it can kind of, if that cash starts going up over time, which they expect it to do, starting in 2025 and beyond, if that cash continues to grow, they'll have an extra kind of income stream with investments that will grow over time as well. And that's really what we want to see going forward. So all in all, it's a really strong quarter. All those numbers I mentioned were much better than expected. Lemonade is investing heavily in growth, which kind of scares some people, and for good reason. But as long as they're producing these kind of numbers, and especially on the profitability end of the equation, if they're producing that kind of profitability, then it is definitely a good use of capital. And I can't say enough good things about this quarter. I think stock-based compensation, as I mentioned, is still way too high. I think I'd like to see them have a plan to get that under control. $64 million in annual stock-based compensation from a roughly $1 billion market cap company is, I don't want to say outrageous, but it's definitely kind of up there. I'd love to see them have a plan to get that under control. And I'm going to be watching over the next few quarters to see if they can keep that loss ratio down, especially when it's not a seasonally strong time of year. But I'd love to hear what you think. Are you a Lemonade fan? Do you think I should get out of the stock? Do you think they're heading in the right direction? I'll do my best to answer any questions or comments you have individually. And thanks for watching, and I will see you next time. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.